Hello, all. I'm Mamta Rawat from the Corporate Communications team at CareEdge Ratings, and it's my pleasure to host today's webinar on Indian affordable housing finance companies, growth and emerging risks. Thank you for taking the time to join us. Before we begin, I'm delighted to introduce our esteemed panel of speakers. Mr. Dev Shankar Tripathi, Executive Vice Chairman at Aadhar Housing Finance Limited. Mr. Ravi Subramaniam, MD and CEO, True Home Finance Limited. Mr. Abhishek Bisain, Head of Fixed Income and Fund Manager, Kotak Asset Management Company. This session will be moderated by Mr. Priyesh Ruparelia, Director at CareEdge Ratings. We will begin this webinar with a presentation by Associate Director at CareEdge Ratings. After the presentation, we will move into a panel discussion followed by an audience Q&A. For any questions, please type them into the chat panel. We will address them towards the end of the session. With that, may I invite Aditya to make the presentation?
Yeah. Thank you, Mamta. Good evening, everyone, and thank you all for joining us. Affordable housing finance companies in India play a crucial role in bridging the gap between the growing demand for housing and the financial resources available to low and middle income groups. In a country where rapid urbanization and rising property prices have made home ownership difficult for many, housing finance companies that cater to this segment help promote inclusive growth by enabling more individuals and families to achieve their dream of owning a house. Over the past decade, the Indian government's emphasis on schemes like the Pradhan Mantri Awas Yojana has further strengthened the affordable housing ecosystem, encouraging both public and private players to develop cost-effective housing solutions. By improving access to structured finance for the underserved segments, these institutions support social stability and economic development, making home ownership more possible across diverse income groups in India. In this presentation, we shall discuss the market share and AUM growth of affordable HFCs, margins and profitability, funding profile of affordable HFCs, asset quality, and CareEdge Ratings view on the sector. We'll now look at the overall housing finance market, which is still dominated by banks, especially for large and premium home loans. There are larger HFCs that also focus on prime segment, which are also in competition with banks. But when we look at loans with ticket size of under rupees 25 lakh, these HFCs which have strategically positioned themselves in the lower ticket size segment lead the market. If you look at the chart, the share of affordable HFCs in overall HFC portfolio has risen steadily from around 10% in March 2021 to around 18% in March 2025. If you look at the customer segment for affordable HFCs, majority of the customers are self-employed, constituting nearly 60% of the total AUM. There are few affordable HFCs which focus largely on salaried borrowers, but majority of them focus on the self-employed customers. Although 40% of the AUM is salaried customers, a significant proportion of that is informal salaried. Since the borrower segment catered by these affordable HFCs largely constitutes lower and mid-income group, it requires specialized underwriting skills to assess informal income. As a result, these lenders maintain low loan-to-value ratio on the property mortgage. Further, a sizable proportion of AUM of affordable HFCs constitutes loan against property, where the LTV ratio is even lower than individual home loans. If you look at the chart on the right, around 48% of the portfolio has LTV ratio of less than 50%, while nearly 89% of portfolio has LTV of less than 80%. Let us now look at the key trends in the affordable HFC segment. The AUM of affordable HFCs has grown at a CAGR of around 18% from FY21 to FY25, supported by increasing demand for homes, rapid urbanization, and demographics. Growth was also supported by government push through the subsidies through Pradhan Mantri Awas Yojana. If we look at the chart, AUM increased in each year from FY22 to FY24, but from FY25 onwards, the growth rate has come down, partly due to increase in base. If you look, a sharp fall in the AUM growth to 21% in FY25 is also due to reclassification of disbursements, adjusting to which the AUM growth would have been around 25% in FY25. Going forward, while the demand continues, we expect the AUM growth rate to stabilize at a lower rate of around 20% in FY27 with a larger base. If you look at the capitalization level, many of the affordable HFCs have been backed by private equity firms, which have infused significant amount of equity to fund growth in AUM. A few companies have been listed in the last few years. As a result, historically, the debt to equity ratio has remained low at around 2 to 2.5x. As the AUM increases, the leverage is expected to see some increase to around 3x in the near term. Let us now look at how the yields and margins have moved for the affordable HFCs. With repo rate cuts during the current year, affordable HFCs have seen a reduction in borrowing costs in the first half of the financial year. However, the yields on loan portfolio have remained stable as transmission of rate cuts has not yet fully happened. Many HFCs have now reduced the lending rates, which will result in softening of yields over the next few quarters. As a result, there will be some decline in the net interest margin in FY27. To prevent this margin fall, players are expected to increase the proportion of LAP, which is a slightly higher yielding product, to maintain the margins. If you look at the product mix of the players, the proportion of LAP as a percentage of overall AUM is rising and increased from around 23% of AUM in FY22 to around 31% of AUM in FY25. As players look to maintain yield, the proportion of LAP book is expected to increase further, but within the regulatory permitted limits. Coming to the cost of affordable HFCs, the operating cost to total assets ratio is higher at around 3.5% of total assets as compared to larger HFCs, which is around 1.25 to 1.5% of total assets. As the portfolio scales up, the operating costs are expected to come down with operating leverage kicking in. If we look at the credit cost to total assets, there has been a reducing trend post COVID-19 with improving asset quality parameters and growth in AUM. However, we expect credit costs to inch up in the near term as the portfolio sees seasoning. Many players in the affordable housing segment do direct assignment largely of the LAP book. This also helps in maintaining the regulatory principal business criteria. Off-balance sheet exposure constitutes to around 20 to 25% of AUM for these companies. The income from DA of loan portfolio is booked upfront and helps in improving profitability. Income from DA has contributed to around 5% of total income in the last 3 years and is expected to help the profitability in the near term when the NIMs are expected to decline. A look at the asset quality, the parameters for affordable HFCs have remained stable over the last 3 years, with gross stage 3 remaining in the range of 1.5 to 2%. Provision coverage ratio for GS2 plus GS3 has ranged between 45 to 50% over the last 3 years. There has been a marginal uptick in the GS3 as well as GS2 in the first half of FY26 and is expected to continue in FY27 as the portfolio seasons. A look at the resources profile, the borrowing profile of affordable HFCs continues to comprise largely bank borrowings, which constituted around 65% of total borrowings. Capital market borrowings constituted less than 20% of the borrowings. The affordable HFCs have access to NHB borrowings, which has remained broadly stable in the range of 16 to 18% of total borrowings. Companies have now started exploring alternative funding sources like external commercial borrowings, which form a small portion of total borrowings. However, bank funding continues to remain the major funding source. Now we come to the outlook for the sector. The AUM growth of affordable HFCs is expected to stabilize at a lower rate. AUM in FY27 is expected to grow at around 20%. Share of LAP will continue to rise as the yields soften. Increase in direct assignment is likely to improve the profitability of the players, which is expected to remain stable with a ROTA of around 3.5% in FY27. Credit cost may rise slightly to about 0.4%, but overall asset quality should remain stable. Leverage is expected to increase but stay comfortable at around 3x. With this, we come to the end of the presentation. I now hand over to Mamta to take the proceedings ahead.
Thank you, Aditya, for that comprehensive overview. A quick reminder to all attendees, please keep sending in your questions. We'll take them up during the Q&A. Now, I would like to invite our moderator, Priyesh Ruparelia, to take the discussion forward. Priyesh Ruparelia is Director and Rating Head, BFSI sector at CareEdge Ratings, and has a diverse experience of about 19 years in the field of credit ratings, research, banking, and IT services. He has worked on multiple credit rating assignments across the BFSI and corporate sectors. Prior to CareEdge Ratings, he has worked with ICRA, ICICI Bank, and Wipro Technologies. Priyesh holds a bachelor's degree in engineering from University of Mumbai and an MBA in finance from NMIMS Mumbai. Over to you, Priyesh.
Thank you, Mamta, for the introduction. And good evening to all the esteemed panelists and participants. We are truly honored to have with us three highly distinguished panelists with us who bring decades of leadership and expertise. On behalf of Care Ratings, I would like to sincerely thank them for taking time out of their busy schedules for today's event. Before we proceed, let me highlight that the views expressed by our panelists today are their personal perspectives and may not necessarily reflect the official stance of the institutions they represent. Let me start with the introduction of our panelists. Our first panelist is Mr. Dev Shankar Tripathi. Mr. Tripathi is Executive Vice Chairman of Aadhar Housing Finance Limited. As CEO of Aadhar Housing Finance Limited, he led the company's transformation from a regional entity into one of India's largest low-income housing finance companies, expanding its footprint across 20 states and union territories. Mr. Tripathi holds several certifications, including a diploma in public administration from Awadh University and a certified associate from the Indian Institute of Bankers. He also completed the Strategy and Management in Banking program at the International Development Ireland Limited, Leadership Development Program with NIBM Pune, and Kellogg's Institute of Management, USA. Welcome, sir. Our second panelist is Mr. Ravi Subramanian. Mr. Subramanian is the MD and CEO of True Home Finance Limited. He has over 3 decades of experience in banking and financial services industry, having held leadership positions at prestigious institutions such as HSBC, Citibank, and ANZ Grindlays. An alumnus of Indian Institute of Management, Bangalore, Ravi has been instrumental in driving the company's growth and transformation. Welcome, sir. Our third panelist is Mr. Abhishek Bisen. Mr. Bisen is the head of fixed income and fund manager at Kotak Mahindra Asset Management Company. Mr. Bisen manages 21 funds of Kotak Mahindra Mutual Fund. He has been associated with the company since October 2006, and his key responsibilities include fund management of debt schemes. Prior to joining Kotak AMC, Mr. Bisen was working with Securities Trading Corporation of India Limited. He has been awarded twice as one of the highly commended investors in Indian rupee bond from the Asset Magazine, Hong Kong. His educational background is BA in Management and MBA in Finance. He has also completed an executive program in Applied Finance from IIM Kolkata. I again thank our esteemed panelists and participants for joining today's discussion. During the discussion, our participants can post their questions through the Q&A box on their screens, and we will take them up during the session. With this, let me start with the panel discussion. So my first question is to Mr. Tripathi. Sir, in the context of presentation shared by Aditya just now, where do you see the affordable housing finance market evolving in terms of growth over the next 3 to 5 years? And how do you see the competitive intensity from various players, including the existing and new AHFCs or prime housing entities as well as banks?
Thank you, Priyesh, for the nice introduction. I think Aditya has given the presentation the growth prospect of around 20-22%. I think that this growth percentage in next 5 years will have to be maintained for the reason that there is a massive demand. But presently, if you look into any property consultant views or the market, that the entire housing market in the country is dominated by the luxury and prime housing, and they are growing with a very faster pace. Secondly, because of the one other thing that the rise in the property prices, the affordability for the low income customers is slightly becoming a question mark in the metros and tier 1 cities, not in other cities. But when I talk about the growth, despite the luxury and prime housing is growing very fast, the affordable housing finance is maintaining its pace. Value-wise, you are saying that growth may not be substantial, and if I submit you some data, in 2021, loans below 25 lakhs were 30% for the industry as a whole. As of March 25, it has come down to 20%. While loan above 50 lakhs were 37%, which gone up by 54%. That clearly reveals what the property consultants are talking and what the market itself, news items are telling, that luxury housing is growing. But if I talk about HFC portion, overall HFCs, it was 43% in 21. And today, it is still 35%, despite the rise in the value in the housing because of the luxury and the premium housing sale. So my point is that, and if you further dissect from HFCs to HFC, excluding the bigger HFCs, probably it was around 42-43% in 21, and today around 37-38. It means loan below 25 lakhs are still relevant, but the rise in the cost of pricing, the loan below 15 lakhs has slightly reduced, and it has migrated to 15-25 lakh or 25-35 lakhs. And today, if you look at the RBI definition or whether the Niti Aayog recommendation, they are treating as the 35 lakh rupees loan for the population below 10 lakhs of the country, where the population in the towns is 10 lakhs. So I think 35 lakh rupees loan is going to be relevant from our point of view. But EWS LIG, they have a problem. EWS can't borrow more than 12 lakh rupees because 3 lakh rupees is the income size. LIG can borrow up to 23-24 lakh rupees. That's why the government of India in the PMI 2.0 has added MIG up to 9 lakh rupees income. That takes up to 35 lakh rupees. Now, to corroborate the demand side, what is the deficit? What is the shortage in the country is there? The most relevant is the Knight and Frank report about a year back they have published, which Niti Aayog in its recent framework for the affordable housing recommendation, they have also incorporated. They are telling 31.2 million housing requirement is there in the country by 2030, of which 46% is going to be EWS requirement, 33% for LIG requirement, and 16% for MIG. 5% of MIG you can leave it because we are talking about the affordable housing finance here. And the total shortage in terms of unit is 15.5 million for EWS, 10.9 or 11 million for LIG, and 5.3 million for the MIG. That is what the shortage of unit. And they have expected what is the total market requirement for these units going to be in next 5 years. That comes 67.1 trillion for overall, and the potential for the loan is around 51.6 lakhs trillion. And now I will dissect into the lending opportunity for EWS is around 12 trillion. For the LIG, it is around 17 trillion. For MIG, it is around 14 trillion. So 44.6 trillion requirement is there for the lending for the EWSLIG. So that and the lower end of MIG, all three are the affordable housing which now treated by the government of India and PMI 2.0. So considering though there is a high ticket size demand is there, but tier 2, tier 3, tier 4 cities or towns, there is a massive demand is happening. The only problem that EWS are not able to buy a house in bigger metros of 25 lakhs plus population. If they go to other metros of 10 lakh like Lucknow or Jaipur, they are able to take the loan for 12, 13 lakh rupees outskirts. So that is also not problem for them. And today, as of you will see, the total around 39% is share of EWSLIG. So therefore the demand is there. When demand is there, HFCs are all HFCs. Even though HFCs were having some problem 5, 6, 7 years back, they are all in very active mode. Every HFC is growing in the way they are expected and they are making themselves more competent to grow. Capital problem is not there. Aditya himself has told about the most of the HFCs are PE owned. Therefore, the capital problem is not there. It comes about the financing, the liability requirement, that is also not there. NHB is helping from a different refinance schemes. Banks are giving loan, and it is a priority sector for the banking system. That is not getting a problem. So I look forward that the afford industry as a whole may grow around 14-15%, but the affordable housing finance company, they are all set to grow around 20-22%. The bigger companies may grow 21%, the smaller may grow on 30, 35, 40%, but the growth momentum will remain there. And the PMI 2.0, though the subsidy amount has been distributed in 5 years' time, not in a one go, but it is a big kicker. And the government of India is all set to take a lot of initiative in going forward. Niti Aayog framework has submitted a lot of recommendation, and they have desired to improve supply side. The problem in today, the supply side for the low income affordable, that is 25 lakh, is not there. The builders are moving to the luxury side because for them it is not cost effective. They are not very keen to construct houses for a small value. So I think the government is keen on that. All the state government under PMI 2.0 has been directed to give stamp duty and other kind and registration charges concession to EWSLIG, to give a lot of concession to builder for user charges, other thing, give more of an FSI, and many state government has started into moving that. Another very important recommendation which Niti Aayog has said, and the government of India and PMI 2.0 desired that state government must ensure that 10% land in each affordable, in each housing project should be marked for in the town planning also for the affordable housing. So I think supply side will still take a shape, but till supply side takes a shape, the self-construction is one of the important piece where we are banking upon. So therefore, growth part is not a problem. Little bit, if luxury housing is growing, it is nothing wrong. It is good for the total housing sector for the country. But the affordable housing to provide a good house to the common man, to the small people, is the need of the country and need of the for all of us to grow. So I fully am with what Aditya presentation has given. I am fully aligned with him. He has mentioned about that there may be some pressure on the NPA. It was for Q1 and Q2, but now things I am seeing normalized. You will see that housing loan NPA may be around 0.7, less than 1%, and including LAP, it may be around 1.3, 1.4. Overall, for the sector, maybe around 1.5 and upward. The sector has a good prospects all through.
Sure, sir. Thank you for the detailed perspective. And I think your comments on rising premiumization, some supply-related challenges, and various government initiatives, I think that is quite useful, sir. Thank you so much.
See, Niti Aayog has used a very important word. They said the country has to urbanize. And today we are 36.5% urbanization, 40% will be in 2030 and 50% in 2050. And when urbanization will take place, whether EWSLIG income-wise definition changes or not, the people income is increasing. So therefore,
Right.
buying capacity will also take a shape in going forward.
Sure, sir. Thank you. My next question is to Mr. Subramanian. Sir, basically, Mr. Tripathi ji has given nice context of this in terms of what to expect in terms of growth. But sir, when we see geographic concentration across HFCs, we see that it seems on the higher side, and they are largely present in 5 to 6 specific states. So, what would be the key product segments or geographies which will be the next big growth drivers for AHFCs?
So first of all, just want to add a couple of points to what the party said on the growth rate. Well, let's face it, the affordable housing finance companies are at 18% of the 9.6 lakh crore as per Abhishek Aditya's presentation. And that makes it about roughly 1.7, 1.8 lakh crores out of a 40 odd lakh crore of home loan business. The next is about 4.5% of the total home loan business lies with the affordable housing finance companies, which makes it a very, very minuscule proportion of the overall housing finance market. So, with that kind of a scale, growth is unquestionable in the sense that your growth of about 20 to 25% bare minimum will come in largely because of a low base, for sure. And also given the fact that affordable housing finance customers exist across the length and breadth of the country, your demographics are working in favor. The first house is being bought by people at the age of about 32, 33, which used to be about 42, 43 earlier. That's kind of changed. The government has started pushing a lot of initiatives through PMAY and a few other initiatives. Given all this, I think self-employed growth is unquestionable. But the one thing which of housing finance companies need to do is to get out of this salaried mindset. Today, almost every single affordable housing finance company, except possibly ours and one more, focus on salaried a lot more than self-employed. Salaried is low-hanging fruit. It's so easy. It's like lazy banking. And most of them focus on salary, but when you get down to the hinterland, to the tier 2 and the tier 3 cities, it's largely self-employed. India is a self-employed nation. If you don't address the self-employed population, what are we talking about? And two, if you look at you talk about where will the growth come from, you look at the split of this 1.8 lakh crore of affordable housing finance companies AUM. Bulk of it, I wouldn't want to hazard a guess, but bulk of it would come from metros in tier 1 cities. The outskirts of Bombay, outskirts of Delhi, outskirts of Chennai, maybe the largest cities, and a few tier 2 cities. But real India is in tier 3 and tier 4 and tier 5 cities. And that's where your bulk of the affordable housing finance companies' growth will come from in the years to come. Your competition will be lower. Your large players, your larger public sector banks, your larger private sector banks, your larger HFCs and NBFCs will not play a role there. So smaller towns and cities is where the growth is going to come in from. Smaller towns and cities, self-employed cities. Smaller towns and cities are self-construction driven cities. You get these products right, you will actually be able to grow in those cities. The challenge I've been saying now, and I've said this in the past as well, is talent. You get to tier 2, tier 3 cities, you don't get enough talent to suitably manage the scale of growth that you can exist in that place. So the moment 4-5 affordable housing finance companies go to tier 3, tier 4 cities, the one with the better talent will win the race and not one with a better distribution. So somewhere that's a point which I would like to make. And I think the government also is today pushing most of the affordable housing finance companies to start focusing on lower ticket, to start focusing on the tier 3, tier 4 cities. And if that kind of takes root, then affordable housing finance companies are in for a good time. I think we are on a very small scale right now. Sky is the limit. 25 to 30% growth distinctly possible. When there will be good ones at 30+% growth, there will be not so good ones at about 10% growth, averaging out to about 17, 18 to 20% growth. But by and large, I think we will be doing this industry and ourselves a disservice if we don't aim for a 25+% growth.
Sure, sir. And just a follow-up question, basically, Do we expect the AUM growth to come more from increase in number of borrowers or more from increase in ticket size of loans going forward?
An interesting shift is happening in the affordable housing finance industry. I don't know whether you are picking it up from CARE, but the interesting shift that's happening is that almost every single affordable housing finance company is moving up the value chain. What used to be 10 lakhs earlier is now 12 lakhs, is now 13 lakhs. And
Right.
my guess is most of them have started focusing on the 25 lakh plus ticket size segment. It's a mix of market saturation at the lower end and inability to grow at the lower end. And that's the reason why most of them are focusing on the 25 lakh plus ticket size as well. So I would not say that the growth will come from more number of customers. The growth for people who are not already there will come in from an increase in the ticket size for sure.
Sure,
For
sir.
us, for example, I can talk about myself. For True Home Finance, particularly, the average ticket size has been static for the last 4 to 5 years because we've zeroed in on a particular segment and stayed true to that segment for the last 4 or 5 years. And thereby, our growth has come in through addition of branches and additional number of customers. But I'm not too sure if I can say that for a lot of other players in the industry.
Just to add what Ravi has said, the ticket size, if you see, most of the HFCs is more or less slightly rising by about 10-20% every year. If somebody was having 10 lakhs earlier, after 4 or 5 years, they may be having 12 lakhs rupees. So 10 to 12 lakh rupees in 5 years is not a big jump because it is inflationary trend. One question you raised that about geographical concentration. Actually, if you see that southern states are contributing 39% of the AUM of the entire housing sector. And probably in next 4 or 5 years, it may come down to 38%. It means the massive demand in southern states. That's why most of the companies are concentrated there. That's one thing. Then comes to the western, like Maharashtra and Gujarat only. They are also around 31%. The problem is only the east, which contributes only 7%. And
Right.
likely to grow to 8% next 4 or 5 years. In fact, Bihar, West Bengal, Odisha, they are likely to become growth centers in next 4 or 5 years. Most of the companies, because of some credit culture, other things, they are not going to concentrate there, but they are now moving there. When demand will come, they have to be there. So the developmental phase takes place in every state. So I personally believe that today, if 10, 12 states are contributing around 85% of the total AUM, in next few years, about 15 states will, 5 more states will join into that. That's why I've added to that.
Sure, sir. Thank you, sir. So my next question is to Mr. Bisain. Sir, given that AHFCs generally target informal segments with lower ticket size, so as an investor, does it impact the confidence of, say, other investors on the quality of books, etc.? What is the sense you are getting, sir, from the market?
Yeah, hi, a very good evening, everybody. Thank you so much for having me on the panel for the discussion. Yes, if you look as a overall perspective, it definitely gives some amount of doubt as such because it is dependent on the informal sector and difficult to assess what is causing the volatility, and it's unpredictable. But given the average low ticket size and the diversity which the diversification in the book offered, that is a source of comfort. So while it can be volatile, but source of volatility is very difficult to pin down to. So it creates some amount of discomfort, but it's obviously offers that diversity and diversification, low ticket size. And one thing more that in the small ticket size segment or tier 2, tier 3 segment, which is Bharat, so-called, we call it Bharat. The house is not just a house, not just an asset, it's an aspiration. It has got a lot of sentiments. Therefore, intuitionally or intuitively, it is understood that or the right, and that's what probably is shown in the data as well.
Sure, sir. And are there any concerns with respect to growth and asset quality within housing and lab book of affordable housing entities?
Not yet, but given it is in the tier 2, tier 3 segment, the larger action is happening in that segment only. And the rate, because the overall size is very low, therefore percentage looks slightly on the higher side. But these kind of numbers are fairly okay. I mean, that is expected from a such large demography, such large diversity. It is expected to grow at that larger pace. So we don't see any. In fact, that there is where the real money or real action is, and it is expected to grow, and we are actively watching this space.
Sure, sir. Thank you. My next question is to Mr. Tripathi. Sir, you talked about various growth drivers earlier and other enablers also, such as PMAY schemes by the government. But sir, in terms of the current PMAY schemes, how do you see them panning out, and are there any specific challenges associated with this scheme or any other scheme of government which could be acting slightly as a constraint for us to operate?
You see, if you look into the PMY 1.0, where the subsidy was upfront, now the subsidy amount is reduced to 1.80 lakhs and it goes 36 lakhs rupees per year. But why this will not be a constant? Because all the lenders, when they are giving loan, they make assessment based on the cash flow without PMI subsidy, because subsidy is always received after the loan is disbursed. So therefore, the PMI subsidy, which is whether reduced or are coming in 5 installment, it has one added advantage, because if 36,000 per year comes, probably if some low income segment customer have some cash flow problem and making repayment, that improve its repaying capacity in that point one. Secondly, he has no incentive to get account BT to other organization. Earlier, he got subsidy and he was getting transfer the account, or lot of manipulation was happening. Some middleman people, they were getting the loan in somebody else's name and getting subsidy and going out. So this PMI 2.0 is very well designed, because government knows that repaying capacity assist minus PMI subsidy by all of us. That's one thing. Second, for 5 years, the customer has to keep the house, because the purpose of creating more housing stock, not purpose of giving subsidy. And third thing, if he defaults, he will not get the subsidy, he has to refund it. So all these things are a disincentive for a customer to be in the house. So therefore, the genuine customer will come, which is the prime objective of the government, and this will always ensure that the repaying capacity every year is properly supported by the subsidy amount. So that is what I feel. That is one of the very important and thoughtful schemes. Some people might be talking amount is reduced, amount is not given in one shot. So I think that is very well designed. That will not impact the growth. As Ravi also mentioned in the beginning, the growth will continue. Growth comes from the need of a customer. And today, most of the affordable low-income segment in India, the people still rental housing scheme. Why it is not taking up? Because the purpose is that people are still needs to have an ownership of house, and the age of buying a house, which used to be around 35, 36 years, is getting reduced. The moment a child gets a job in 23, 24 years of the age, and he is living in 3-4 persons in a family, he prefers to take another house. That's the reason the demand will keep on multiplying, and the need of a customer and repaying capacity will continue to spur the growth. Another segment which government added with the PMI 2.0, they have launched the PMI credit guarantee. They have launched the credit guarantee fund scheme also, which helps the lender to secure 70% of the loan amount in case of default, about 20 lakh rupees. Probably this may get increased because Niti Aayog has recommended to move it to 40 lakhs, because today 20 lakhs should go to 40 lakhs, but that is definite. But 20 lakh rupees, those who are, as Abhishek, you are telling, why is comfortable? Because if I am feeling my customer is the self-employed and low-income segment, I am getting guaranteed with a very small one-time premium. So a company is secured with 70% of the guarantee amount. So all these things are enablers for that.
Sure, sir. Thank you. My next question is to Mr. Subramanian. Sir, we talked about some of the supply side challenges and basically some of the constraints being faced on the supply side. What are the strategies AHFCs are adopting to mitigate the supply side issues on the ground?
Yeah, I sometimes, as an industry, we make too much about the supply side issues. We are talking of, as I mentioned in my earlier answer, we are talking of 1.6, 1.7 lakh, 1.8 lakh crore as the total AUM of the entire industry per se, in the affordable housing finance space. And trust me when I say this, a 1.8 lakh crore industry does not get swayed by macros. I know Mr. Tripathi actually pointed out a few numbers in terms of on the supply side shortfall, etc., etc. But end of the day, when you go to tier 2, tier 3 cities, tier 4 cities, and you're looking at self-construction, the supply side gap does not really matter. The supply side issues in terms of apartments, in terms of affordable housing, etc., comes only in your metros and your large cities. When you go to the smaller cities, this problem does not arise. And I think despite the supply side issues, despite the fact that there is a huge shortfall of affordable homes in this country, partly because of the affordability and partly because of the builders being reluctant to get into the space, there is still enough scope for this industry to grow at 25% per year without breaking into sweat.
Sure, sir. That's a slightly different perspective, but yes.
It's too small. Yeah, 1.8 lakh crore affordable housing finance. The top five affordable housing finance companies are a lakh, and the balance all 30-40 put together are like 70,000-80,000 crores. Then,
Right.
and we have 600 branches. So let's take Aadhaar, for example. Okay, they have 600 branches. I can't talk about mine right now. 600 branches. How much will I supply? One loan per branch extra is 600 loans.
Right.
I know businesses don't get built on Excel, but really to do 1 or 2 or 3 or 4 more loans in a branch, you really don't need to worry about the macroeconomic factors. That's for the analysts and that's for the larger policymakers to worry about in the long run for the next 10, 12 years. But also supply side issues, let's face it, you can't take care of it. And if you start doing anything about supply side issues, it's going to be 5 years till anything comes out of it. So the best thing is to focus on what is at hand, look at the market which is addressable, run after the businesses that you can do, and still deliver a 25% growth. That is my mantra, and that I think is a good mantra for affordable housing finance companies to follow. I'm sure Mr. Tripathi, being at the helm of the largest affordable housing finance company in this country, would also agree to it.
Appreciating the views of Ravi, I tell you, in entire country, there will be hardly 40 or 50 cities are there where builder supply is there. If we check up, not more than every consultant talks about 8 top cities. If you take the smaller cities like Lucknow, Jaipur, Bhopal, there is also some supply is there, which comes from the government-led development authorities and from some small builder. So what supply we get, that gets from the informal builders. What supply the government is talking, their supply should come from the affordable housing in partnership project. If those projects take off across the, at least if not in tier 3, tier 4, I'm not talking. I have 650 branches. More than 400 branches are doing self-construction loan. They are not doing. But still for the LIG and MIG segment, who are living in the cities, they need 1 or 2 bedroom flat where the communities type of feeling comes. So now the most of the low-income borrower also feel they should not take a one house somewhere here and there. They should have a community type of feeling. Still, there is a mindset of having a bungalow type of independent house, but the supply side, if it improves, which the government is taking initiative, that is for the what Ravi has told, that is demand is used in the metros or in the 10 lakhs plus population cities. So I fully agree with him. So growth can come less than 10 lakhs also. But most of the people are coming for livelihood in the 10 plus lakhs cities where you need at least 1 or 2 bedroom apartment. If they get, like if you go to Surat, if he can get 15 lakh rupees house, why he will not buy? And he will stay there. That is what supply side for the low income, because all government initiatives so far have been demand focused, not supply focused.
Right.
PMI 1.0 gave the tax holiday to the affordable housing in partnership, but this time it is not there. So that's why the government is looking into that, how we can revive that. So my point was from that side.
Sure, sir. Thank you. My next question is to Mr. Bisain. Sir, in terms of AHFC as an asset class, you as an investor, how do you view this asset class vis-a-vis other retail classes, retail asset classes? If you can share your views on that.
Yeah, this is a very important question as far as mutual fund asset holdings are concerned. So typically below AA in terms of rating, be it housing finance or be it any NBFC, all are same as a asset class or as a bucket. So that's where you face a reasonable amount of challenge in terms of competing on the rates term, because if you talk about credit quality, in terms of credit quality, you are much better than most of the assets available in the same rating segment. But if you talk in terms of availability of the pricing, then there is a reasonable amount of challenge, because what is happening is both are almost equally illiquid asset, but I'm probably getting 1% percentage and a half better rates in the similar rating assets given the same constraints. So that's where the real challenge is, and the other challenge is sometimes for liquidity, because we as a mutual fund we need to have reasonable amount of liquidity. So if you are having illiquid portfolio in your book, might as well get slightly higher or try to maximize your return for your unit holders. So that's the idea behind. Otherwise, if you look from matrix point of view, your credit quality point of view, things are fairly okay. We are quite comfortable as such in terms of credit profile, growth, etc. But when you talk about pricing, that's where you face real challenge, and the space is slightly crowded in terms of rating.
Sure, sir. Understood. My next question is to Mr. Tripathi. Sir, in terms of movement of yields and margins in the current interest rate environment, what is your sense? What to expect in coming quarters, sir?
It's a very lovely question in the present context when every customer, once RBI reduces the repo rate, everybody expects it to go down. Actually, in competitive scenario, if we have to be there, so new loan disbursement rates are already aligned as per the market requirement. Still, the margin is there. Most of the companies are having 5 to 5.5% interest spread, which may continue for next 2 years because the cost of borrowing is also coming down. If we have to pass it on to my existing customer I'm talking, so my cost of borrowing, which was 8.5, 8.4% about a year back, has come down to 7.5. It may come down to 7% in next 6 months. So my point is that if my 1.5% cost of borrowing will come down, and then probably the new loans will be around that only. The only thing, the competitive pressure from the banks we are not facing. Market always feels that banks are moving into this segment. Banks are comfortable in co-lending and buying our portfolio. Why they will soil their hand in going to tier 3, tier 4 cities? Their branches are there. If they do 50 lakh, 60 lakh rupees there, they are comfortable in that. So in self-employed segment, was Ravi is telling, which is going to be the most important segment for everybody. Like my company has only 55% self-employed. So I have enough lever to increase self-employed to maintain my yield by reducing salaried segment. So that is the I say, the golden jewel for us, because we can still go to 70% to 70% self-employed and 30% salaried segment, which we may have 5 years of the opportunity for there. So most of the companies will continue to have a proper margin. It will keep on reducing slightly. If our size increases and the margin reduces, my you see, the ROA and ROE will remain maintained. I don't feel like that. Some pressure will always be there. But competition from a small finance bank is not there, because they also chase the same yield. Competition from the public sector bank and the good private sector bank is not there, because they go for the co-lending and other thing. So I do not think, you have seen from last 6-7 years, this model is going on. Government, of course, is pushing that the company should reduce the interest rate by refinance from the NHB. I will pass it on to customer. We are doing it. So I
Right, sir.
feel that there may be side pressure, and I think it is good to have some pressure.
Sure, sir. And just a follow-up, sir, to that question, sir. Will the proportion of direct assignment increase as we try to preserve our profitability levels in current competitive environment, sir?
I don't think till now we have not increased. We are maintaining same, because I personally believe that is one way of increasing the thing. But you mentioned earlier the lab is growing. You mentioned
Right.
earlier. What lab grows, we assign that to the banking system.
Right.
So therefore, we maintain principal criteria also, because say for us, it is around 30% disbursement in lab, and book-wise it is around 25%. If we increase the 2% lap also, we will sell to the banking system. That will help us in maintaining the yield. But there are various levers. Either you increase the lap and assign more, increase self-employed. And that way there are many levers, and the risk-adjusted returns remains very good. So I personally do not foresee that this we will do. But going forward, I can't deny that we may have to do if it is required. But even if 5% spread is there, again 5.7, 5.6% spread now, I'm comfortable.
Sure, sir. So my next question is to Mr. Subramanian. Sir, coming to the next part of that profitability chain, which is OPEX. So we see that OPEX to total assets for affordable housing finance entities are slightly on the higher side, obviously because of the inherent borrower segment. But in terms of formalization or digitization, how the role of AI would help us in reducing this OPEX going forward?
Yeah, currently, if you look at the affordable housing finance companies, the cost OPEX is roughly about somewhere in the range of 3 to 4.1, 4.2% of your total loan book. That's the way the OPEX moves for most of the affordable housing finance companies. And it is in that range largely because of a few reasons. One of them is lower ticket size, and hence the costs involved in underwriting those loans. Two is the fact that most of these affordable housing finance companies have a low AUM, and thereby the costs which get portioned over lower portfolio reflect higher. Three, and had there been a scale, the numbers would have looked very different. Three is the fact that it's a very people-intensive job, and thereby you have a fair bit of fixed costs. And for most affordable housing finance companies, if you see, it's not your OPEX or the back-end costs, but it's largely your sales and the front-end and your underwriting costs, which probably take up the bulk of the costs. Most of them are people-intensive. You need about 4,000 sales guys on the street, etc., and you need an army of underwriters to underwrite these loans, and those add up to the costs. Yes, your AI will aid in giving you underwriting tools which can give you a better score and thereby help in underwriting customers easily. But let's face it, the underlying aspect of all artificial intelligence has got to be data. And when you're underwriting a self-employed customer in this segment, the data is the thing which is missing. You don't know enough about the customer to underwrite the customer through artificial intelligence means. So And that is where the challenge for most affordable housing finance companies lie. Today, almost every single customer that I underwrite is on an assessed income basis, which is my credit underwriter goes, meets the customer, sits with him, draws up his P&L, figures out what his affordability is, how much EMI he can pay, and then thereby assess the affordability for a particular loan. Now, for AI to do that, I'm not saying it's impossible, but it'll take some time. So if you ask me if AI is going to be game changing in the next 12 months, maybe 18 months, I would say no. Will it bring down costs in certain manner? Yes, it may bring down costs by about 15 to 20 basis points. But beyond that, I think the only thing which will bring costs down is scale. Today, if a true home finance goes from 22,000 crores to 40,000 crores, or Aadhaar goes from 28, 29, 30,000 crores to 60,000 crores, the numbers would look very different.
Right.
You look at how the cost, OpEx of something like a PNB housing looks like. It's
Right.
probably 1/3 of the OpEx costs of Aadhaar and True Home. And that's largely because that's an 80,000 crore company and we are in the 20s. So somewhere OpEx is a function of scale. AI
Right.
will bring it down significantly, but what will bring it down faster has got to be the scale.
Sure, sir. And I had one more question, not related to this topic, but yes, it was related to disbursement. So, given that this segment remains unpenetrated, how much of disbursements is going to happen to new to credit segment, and how much would be in the form of balance transfer? What to expect there?
Prayers these days, the new to credit is coming down. I think for Ravi, also for most of the companies, it has come down to around 17-18%, which used to be around 30% because the formalization is taking place. Some are one other person might have borrowed from somewhere some few thousand rupees person or something like that. So new to credit is slightly coming down, but the behavior of new to credit is always good. I'm telling you, Ravi may agree with us. That is there. So and as the balance transfer is concerned, if you check out the data, the balance transfer for the premium housing finance company is more. And for
Right.
affordable housing finance company is not that much. For my company, it is in the range of sometime it goes 6.2, sometime it comes down to 5.5% of the opening balance of April. So which is not much. Even if you go to some banks also, they may have 8-9%. Because the competition there is much on getting the higher value loan than the other cases.
Right.
In-house balance
Right.
transfer in my company don't encourage. We hardly have 1% BT in. We have 5.7% BT out, but hardly we have BT in 1%. That we, as a policy, we don't encourage too much.
See, affordable housing finance companies, which largely do home loans, BT in is not a great proposition. You're already giving loans at 30%. So who will you BT in from? And that too, because these loans are low ticket size, the property is of a lower value. And if you're BTing in a home loan which is already juiced out an LTV, how will you give him more loan? And that's the reason why BT in is a bad proposition. If you do LAP, then yes, there is LAP is largely for the entire industry a BT product, but we frown on BTs because BTs traditionally don't perform as well as the normal assessed loans. And LAP BT in for us would be somewhere around 10-12%. But the industry at large does a fair bit of
Right.
in on LAP. And to me, that's a reason to be worried about. My message out there is be careful on BT. BT has a lot of negativity associated with it. And invariably, when you do lots of BT, you start compromising on the making concessions on the LTVs, the value of the property, etc., etc. So just be careful.
Sure, sir. Thanks for that suggestion. My next question was to Mr. Bisain. Sir, in terms of the capitalization levels we have seen in the presentation that currently HFCs are comfortably placed. But as an investor, sir, what kind of leverage you would be comfortable with for AHFCs, given that their gearing levels are currently lower than that of prime HFCs? And how does this leverage compare with other asset classes in your assessment, sir?
Yeah, so given the kind of growth which is happening and looking at the capital adequacy, see, adequacy is a fairly comfortable number. If you solely go by capital adequacy, it's a no-brainer. But if you look at the gearing overall, it's ranging from 1.5 to close to 3.754. So that range is fairly comfortable given the kind of nitty-gritties this segment faces. So higher leverage than probably 3.5 or 4 may show some red flags in the overall market scenario. But around 3 is a fairly comfortable number. Should not have any issues for refinancing and funding your liabilities.
Sure, sir. I think that is the level we, as a rating agency, also, I think, usually look at as a threshold. So I think
Yes,
heartening to see that it aligned on that front. So
perfect.
thanks for that, sir. Let me start taking up audience questions as well. The first question is from Darshan Devra. He's asking, what is the view of the panel on disbursement growth for affordable housing sector? Is the current slowdown in disbursement growth a structural issue or a temporary blip? Mr. Tripathi, would you like to take that up?
I don't think that when the March will close, you will find that the growth will be in tandem with what you were expecting and what was the last year. Of course, I agree in the initial Q1 and Q2, some growth was seen slightly lower, but it may be taken as a structural issue because most of us has moved on the check realization and all that. That may be an issue, but growth momentum is going to be what Ravi and I mentioned, between around 21, 22%. Some may have 25, 30%, some may have 20%. But there will not be any pressure on the growth in the affordable housing, irrespective of what situation may be. Only thing that some sort of occasional problem keeps on coming. Initially, the microfinance sector was in a problem, but that did not impact all of us because we are in a completely different segment. When you are changing too lower ticket size, then probably it may be a challenge.
So if you look at it, just to add to what Mr. Tripathi said, Q1, Q2 of this year, there were some delinquency issues which the industry was saddled with. You suddenly
Right.
saw one DPD for most of the players go up. And typically, you would see, Darshan, that when delinquency issues creep in, growth takes a hit. And it's the first casualty. And so I think in the Q1, most of the people were focused on getting their portfolios back in shape. And that's
Right.
when a bit of growth took a beating. But Q3 has been a very good quarter for most of the players. I expect Q4 also to be a good quarter. And so as Tripathi ji has said that, it was the microfinance issues which kind of slowly crept into the lower end of the segment and thereby vitiated the entire credit environment a bit. I think that was one of the reasons why the growth took a beating earlier on. But I think now it's back on track. And for most of the players, you would actually see a outstanding Q4.
Sure. There is a question from anonymous attendee. The question is slightly specific to Bangalore and Hyderabad markets. The question is, how is the micro market of Bengaluru and Hyderabad in terms of housing and housing mid-market segment? There seems to be hiring freeze and people losing jobs due to advancement of AI. How would the growth pan out in the near term? Mr. Subramaniam, would you like to take that up?
In talking about Bangalore and Hyderabad, huh?
Yes, Bangalore and Hyderabad. Yes.
Mid-market and other market, Bangalore and Hyderabad are, for housing, they are a very good growth market. It is not that people are, that is of course there because of AI, those who are employed in the different companies, they are losing the job. That may get some impact because ultimately my customers are those who are employed or who are doing their business. But again, as you mentioned, this may be a temporary structural issue. If somebody is losing job in an IT company, he will get some other job also, and probably in few months' time he will learn AI. Then he can again go there. So the AI are cutting the job in different companies. It will happen in future, but there will be alternate opportunities will available. I have not seen that when IT came, everybody was saying there will be large scale employment. Today, IT has created more jobs than it was expected. And similarly, I believe AI impact may be for some time, for which the most of the government are aware of that. But in beginning, of course, if happen suddenly, it may be slightly jerk may come, but I don't think that is going to affect because alternate markets will be available for the housing company's growth. Ravi, you can give your
So we don't face too much of a challenge in terms of either growth or credit quality in the micro markets around Bangalore and Hyderabad. But having said that, just a word of caution, we've instructed our team to go slow on or exercise a bit of caution on particularly salaried employees in the micro markets of Bangalore, particularly not Hyderabad as much, but because we worry that people who lose their jobs may not be able to find jobs easily and thereby may not be able to pay up their loans on time. So just be careful. And two, intrinsically, when there is an air of uncertainty in terms of job, career, continuity of income, etc., people tend to put off their large capital decisions, and that is the reason why we feel that the micro markets of Bangalore, particularly in this segment, may just see a little bit of a slowdown. We are not very big in the salaried market, so take my words with a pinch of salt in that sense. But that notwithstanding, we've instructed our teams to be careful in the micro markets of Bangalore, particularly.
Sure. Next question is from Bala Chidambaram. The question is industry average of 15 to 18% check bounce in current bucket. How to reduce or control this even if we tighten the underwriting?
I think he has raised a very important question which we are all struggling with. Industry check bouncing in case of housing portfolio is around 15-16%, and self-employed is around 18-20%. We are using many methods. We have using data science also to predict the bouncing and all those things. Lot of measures and AI most of the companies are using. There is no other way excepting knowing who is going to bounce. Credit underwriting, when credit underwriting is done, we always assess the cash flow. But one thing we must know, even if check bouncing is 20%, by end of the month, 98-99% recovery is made. So overall, what EMI we expect, the total efficiency for most of the companies is around 99% plus. Because whatever bouncing happens, if 98-97% be recovered and 82% be recovered through ECS, the overall bouncing is quite nominal. Of course, this add to our cost because if bouncing happens, my person has to go, it is there. But
Right.
gradually, we are educating my customers very frequently, sending message, using our data science to predict and all those things. We are doing it. But credit has never been loosened. Credit underwriting has always been irrespective of the nature of customer. It was agnostic to any sourcing, any customer. I don't think credit underwriting needs to be tightened, but other measures have to be taken.
Sure, sir.
I just want to also add to this, Priyesh, and that is that, look, every delinquent customer, every customer who bounces a check need not be a bad customer. Sometimes a customer who bounces a check is good for your business. Because at the end of the day, as long as a customer bounces the check but pays before month end, you make cleaner interest, there's bounce check charges. So you will have to, the only way to reduce bounce is to one, do a fair bit of intense plead, you call it, just to make sure that the customer is aware that his check is presented on that particular day. And also to make sure that the customer is aware that if he bounces his check, there are consequences. All of us tell the customer about his CIBIL getting impacted, but we don't tell the customer that he has to pay a 1,000 rupee check bounce charge, or he's paying a penal interest or thereon. So the moment we start doing that and the customer realizes it, he will pay. The other quick point here is that more often than not, a customer does not bounce a check because he wants to bounce a check. He just bounces because he's incapable of paying on that particular day. So for example, your check presentation day is 5th. The customer gets his salary on the 10th. In this segment, there is no way that he's going to pay you on the 5th. So we are also at times inflexible as organizations of changing his payment due date to 10th and saying, fine, you're getting a salary on 10th, now you start paying on the 10th. So it's a bit of construct issue, our own internal issues, and the fact that this particular segment of customers gets impacted by occasional blips in their own cash flows. We have a higher bounce rate. But 15-16% bounce rates in this segment is a very, very interesting bounce rate, very, very reasonable bounce rate. And as Tripathi said, what matters is how much of that do you actually collect before the end of the month. I've seen people make money at even 24-25% bounce rates. That's fine.
Understood. Thank you. And there are a lot of questions in the queue, but I think in the interest of time, let this be the last question from the audience. I think a couple of questions are common. So I think Saili Zende and Meghna Luthra both have asked a similar question. So let me take that up. How are affordable HFCs dealing with rising competition from other prime HFCs / banks?
I will reply this question. Friends, you have asked very right question, because all the prime HFCs like Aditya Birla, PNB Housing, Tata, they have set up a affordable housing vertical. And in fact, in past, they could not succeed, but this time they have set up a separate vertical and they are doing pretty good. But one thing you understand, when the market is so big, how the competition is going to impact us. The problem comes when the market is very shallow. Affordable housing finance market, as I gave you the numbers by Knight and Frank, and even Niti Aayog has given 5 to 7 crore requirement of the houses by 2030. Niti Aayog has given the finance expenditure council analysis that there is a requirement of 5 to 7 crore, while Knight and Frank has given 31 million and 3.1 crore. This is a huge number. Even if 10 more companies start coming into operate into that, that is not going to be a problem in this segment. And this will keep on increasing. And how they will keep on increasing? Because if a person has got 3 members in the family living in the same one room, the moment they acquire 25 years of age and they start earning 25,000 rupees, a 3 housing requirement will be there. And today the model has come. Then suppose I am living in Bombay, I would like to have another house in my hometown. So there in affordable housing also, if the person has a repaying capacity, he prefers to have another house in the small town from where he belongs other than the working place. So therefore, requirement of the housing in India, where the penetration is only 11% and penetration in China is 28% with a comparable population. So I think we have a number of years to go, next 20-25 years, and the way urbanization is moving. You see, why South we have the higher AUM share than others? Because South states are more urbanized. We should understand that as urbanization takes place, where 5,000 plus population towns are developed, and there the requirement of urbanized housing takes place. In rural areas, you may require 1 or 2 lakh rupees to construct a house. Now, most of the roadside towns are developing. So we all are trying to move there instead of working in metro, tier 1, tier 2. We'll go tier 3 and tier 4. So therefore, requirement has to go up where there will not be much of challenge of supply or anything, and people will have their own housing. So that we need to understand. There's a report that this metro cities are 10 lakhs plus population, which are 61 now, they will move to 71 by 2030. And similarly, the small cities of 5,000 plus population, which government of India is focusing. Government of India has taken 123 aspirational districts where the urbanization is around 9-10%, and there is no housing loan and no companies are there. All these are market will be created. Why we should worry? All top companies, they will concentrate in top about 100 cities. They will not go in top 500 small location in the country.
पाटिल जी आपके नंबर याद कैसे रहते हैं इतने सारे?
सर आपके पास कंपनी चलाने का काम है, मेरे को पढ़ने का काम है, वो कहीं नहीं.
But having said that, I think no competition will be there.
Right.
Competition obviously being there. We had competition from banks earlier. Now you think State Bank of India is not a competition?
Right.
You know, so what is State Bank of India and what are all these HFCs in comparison? So competition has always been there. The only challenge once competition comes in is not the market, but the fact that competition will battle it out for the same talent.
Correct.
And that is what will become a bit of an issue because we don't have good people in the country to run affordable housing for so many companies. And you know, we don't have an HDFC, which was a constant supply of talent for the entire industry in the earlier part of this century. So now it will lead to a battle of talent. It will lead to increase in salaries. It will lead to increase in costs in that sense. But beyond that, I think the market exists and all of us will be able to coexist peacefully in that space. Two, it will be very difficult for prime focused housing finance companies to focus on affordable housing because it requires a complete shift in mindset from a completely document-based assessment to a complete assessed income-based credit assessment. And so it's not going to be easy, but competition is always welcome as long as they don't do irrational.
Sure. I think that's it from my side. Thank you so much, all the panelists. And I would like to hand over to Mamta for closing remarks. Over to you, Mamta.
Thank you, Priyesh, for steering such an insightful discussion. A heartfelt thank you to all our distinguished speakers for their valuable perspectives. It was truly an honor to have you with us. To our participants, thank you for joining us and engaging with us today. We look forward to your feedback. For any further queries, suggestions, or comments, please feel free to respond to the feedback email you'll receive shortly. Goodbye for now. Requesting the tech team to kindly log off.
Thank you.
Thank you very much.
Thank you. Thank you,
Thank you.
everyone.
Thank you so much.
Thank you so much. Thank you. Thank you so much.
Thank you so much.
Thank you, Mr. Abhishek. Thank you, Tripathi.
Thank you all.
Thank you, Ravi.
Thank you very much, sir.
Thank you,
Mr.
Thank you.
Tripathi, thank you.
Thank you
so
for this
much.
whole.
Yeah,
It
thank you,
was-
care team, sir. Thank you, sir.
Thank you, Sanjay ji.
Sir, thank you.
Thank you. So, sir,